What if I told you that most traders fail not because their strategy is wrong, but because they don't know what they're actually trading? Most people think trading success is about finding the right indicator, the secret entry signal, the perfect market condition. But the truth is far more personal and far more uncomfortable. You're not just trading price action, you're trading your emotions, your beliefs, your fears, your identity. Every time you place a trade, you're revealing how you think about risk, control, and uncertainty. Dr. Van K. Tharp's legendary book, Trade Your Way to Financial Freedom, isn't just about systems, it's about psychology. It's about understanding how you shape your results. And it's about building a trading system that fits the most important edge you have, yourself. This isn't just a book breakdown. This is a deep, practical journey into the 7 most life-changing lessons buried inside the pages of Tharp's work. If you're tired of blowing up accounts, if you're sick of strategy hopping, if you want to finally create a path that's profitable, peaceful, and built around your personal truth, then buckle up, because what you're about to hear could change how you trade forever. Lesson 1. The real holy grail of trading is you. Let's start with a dangerous lie, that if you just find the right system, you'll win. That if you copy what the pros do, if you get the best entry strategy, if you time the market just right, you'll finally find freedom. But according to Dr. Van Tharp, that's the exact kind of thinking that sets most traders up for failure. He says, there is no single holy grail system that works for everyone, because even the most profitable system will fail if it doesn't match your beliefs, your risk tolerance, your psychology. Let that sink in. It's not the system, it's you. You're the system. When Van Tharp started interviewing and profiling top traders from around the world, he noticed something shocking. They all had wildly different methods. Some used fundamentals, some used indicators, some used pure price action, some traded 5 times a day, others traded 5 times a year. Yet, they all made money. Consistently. Why? Because they weren't chasing the perfect strategy. They had found or built a system that matched who they were. That's when Tharp realized, you don't trade the market. You trade your beliefs about the market. Why systems alone fail. Let's say you copy a trader with a 70% win rate system. You take their signals. You follow their trades. You even try to match their entries and exits. But after a few losses, you panic. You skip the next setup. You tighten your stop. You exit too early. And now, the system doesn't work anymore. Not because it's broken, but because you couldn't stick to it. That's the invisible wall that most traders hit. They think they need a better system, when what they really need is a system that fits their inner world. What does fitting you really mean? It means your system should reflect your beliefs about how markets work, time commitment, tolerance for risk, emotional response to losses, patience for drawdowns, level of capital and goals. Because if your system doesn't align with who you really are, one of 2 things will happen. 1. You'll abandon it the first time it fails. 2. You'll sabotage it, consciously or unconsciously, before it has a chance to win. The new question to ask. So instead of asking, what system makes the most money? You should be asking, what system is built for me? That's what Tharp calls the real holy grail. Not a moving average cross, not a Fibonacci tool, but a system that's built from the inside out, starting with you. Rewriting the rules. From this moment on, commit to this. Don't chase what worked for someone else. Stop thinking the edge is outside of you. And never again believe that copying success will make you successful. Because real success comes from designing your own path, one that honors your psychology, one that accounts for your weaknesses, one that amplifies your strengths, And that path starts by realizing the holy grail isn't out there. It's already in here. Lesson 2. Your brain is biased, and it's costing you money. You probably think you're rational. You've done your research. You've studied charts. You've followed trading rules. But here's the truth. Your brain is not built for trading. It's built for survival. It's built for quick reactions. It's built for certainty, comfort, and pattern recognition, even when no real pattern exists. And that's why most traders lose. Not because they don't know what to do, but because they can't stop lying to themselves. The cognitive bias minefield. Dr. Van Tharp exposes a brutal truth early in his book. The biggest threat to your trading isn't the market, it's your mind. Why? Because we are hardwired with mental shortcuts, cognitive biases, that helped our ancestors survive but ruin our ability to trade effectively. Here are just a few of the ones that wreak havoc. 1. Hindsight. Bias. You look at a chart and say, I knew it was going to reverse here. But the truth is, you didn't know. You're rewriting your memory to feel smart. This tricks you into overconfidence and bad forecasting. 2. Confirmation bias. You only look for data that supports what you already believe. See a long setup? You ignore the bearish divergence. See a short opportunity? You disregard the support level you would have cared about yesterday. You don't see the market. You see what you want to see. 3. Loss aversion. Losing $100 feels worse than gaining $100 feels good. So you cut winners short and hold losers too long. You say things like, it'll come back. I just need to break even. I can't lose again today. But that's not discipline. It's fear disguised as logic. 4. Overconfidence. Bias. You hit a few winners and suddenly you think you can't lose. You increase size, you skip your checklist, you start trusting your gut. Then the market humbles you, and instead of learning from it, you spiral into self-doubt. The real danger, you don't know you're doing it. That's what makes biases so powerful. They operate invisibly. You think you're thinking clearly, but you're not. Tharp makes it clear. The average trader is not just emotionally fragile, they're mentally misaligned. If you don't learn to spot your biases, they will bleed your account dry over time. Not through huge mistakes, but through thousands of tiny, barely noticeable ones. What great traders do differently? They don't eliminate their biases. They can't. Instead, they do 3 things. 1. They become aware of their triggers. They know when they're more likely to overtrade, overleverage, or second guess. 2. They use checklists and journals to outsource discipline. When emotions cloud judgment, a checklist cuts through the noise. 3. They build systems that protect them from themselves. Instead of relying on willpower, they design their rules to reduce exposure to their weakest moments. One trader's example: the bias loop. A trader loses a trade. Now they're afraid to lose again. So they lower their stop, widening risk. Then the market reverses again, and now the loss is double. To get it back, they double their size. And when that trade fails, they tell themselves it was the strategy's fault. So they start over. New system. New setup. Same bias loop. Unless they become aware, they stay stuck. Start diagnosing your thinking. Here's a powerful exercise from Tharp. After every trade, don't just log price and entry. Log what you were thinking before the trade, what emotions were present, whether you followed your plan or followed a feeling, whether any after-the-fact stories popped up. This turns your trading into a mirror, and when you can see yourself clearly, you can change. Lesson 3. Define success on your own terms. Before you ever place another trade, before you tweak another indicator, before you follow that next high-probability setup, stop and ask yourself one simple question. What does success actually look like for me? Not for Twitter, not for your trading coach, Not for that YouTuber with the Lamborghinis and rented penthouses, but for you, the trader you are and the life you want. Because here's the trap that ruins more promising traders than bad systems ever will: chasing someone else's definition of success. Why clarity is more important than strategy. According to Dr. Van Tharp, one of the biggest mistakes traders make is never defining what success actually means to them. They say things like, I want to be profitable. I want to make a living from trading. I just want to stop losing. But those aren't objectives, they're wishes. Vague goals create vague results. Clarity creates power. If you don't define your outcome in measurable terms, you'll constantly switch systems, overtrade trying to hit invisible targets, feel like a failure even when you're improving, burn out chasing numbers that never really mattered to you. Step 1. Define your ideal lifestyle. Success in trading isn't just about equity curves, it's about freedom. So ask yourself, how many hours per day do I want to trade? Do I want to day trade, swing trade, or position trade? Do I want a quiet, stable income or the thrill of big wins? Do I want to manage capital professionally or just build personal wealth? You can't reverse engineer a system if you don't know what it's supposed to support. Your system must be designed around the life you want to live, not the life someone else flaunts. Step 2. Define your financial objectives. Once your lifestyle goal is clear, now get specific. How much money do I want to make per year? How much capital do I have to start with? What return do I need to reach that goal? And is it realistic? If your goal is to make $100,000 a year from trading, and you're starting with a $5,000 account, that's a 2,000% return. And unless you're a statistical anomaly, that's not going to happen without reckless risk. Your goals must align with your capital and your risk tolerance. If they don't, your behavior will always be out of sync with reality. Step 3. Align your strategy with your goals. Here's where most people go wrong. They find a strategy, then try to force it to meet their emotional and financial needs. But Tharp flips it. First, define your objectives. Then, build or adapt a strategy to fit them. For example, want steady income with minimal screen time? Focus on longer-term swing systems with wide stops and fewer trades. Want high growth and can handle volatility? Short-term momentum trading might suit your risk profile. The point is, strategy follows vision, not the other way around. Why most traders fail at this? Because defining success forces you to face uncomfortable truths. That maybe you don't want to day trade, you just think it looks exciting. That maybe you're undercapitalized and need to build your account slowly. That maybe your goals are based on insecurity, not clarity. But if you don't get honest here, everything that follows will be off balance. You'll always feel behind, you'll always feel pressured, and you'll always feel like trading is harder than it really is. Your trading plan isn't complete. Without this, Tharp is crystal clear. A trading plan without well-defined objectives is just a wish list. Before you test a system, write this out: your time commitment, your risk tolerance, your target annual return, your maximum acceptable drawdown, your preferred level of trade frequency, your emotional tolerance for losing streaks. This becomes your trading compass, and it ensures you never again confuse activity for progress. Lesson 4. Building a system is like building a house. Imagine building a house with no blueprint. You just grab a hammer and start swinging. No plans, no measurements, no foundation. Would you feel safe sleeping in that house? Probably not. Now here's the scary part. That's how most people trade. They jump into the market with no real system, just some scattered indicators, a few YouTube tips, and a whole lot of hope. But hope isn't a strategy, and guessing isn't a plan. According to Van Tharp, trading without a complete system is like building a skyscraper on sand. Sooner or later, it collapses. Why you need a trading blueprint. Dr. Tharp says every trader needs a full, detailed system. one that's complete, testable, and personalized. And building that system requires going through 14 critical steps. Think of these as the blueprint, plumbing, electrical, and support beams of your trading house. Skip any one of them and the whole structure becomes unstable. So let's walk through what goes into building a trading system, step by step. Step 1. Pick a concept that matches. Will you be a trend follower? A reversal trader? A breakout scalper? You don't just pick what's profitable. You pick what fits your beliefs and personality. If you hate being wrong often, don't choose a low win rate system. If you love action, don't build a strategy that requires 3 trades per year. Step 2. Define your objectives. What's your annual return target? What level of risk are you willing to take? What drawdown can you emotionally and financially survive? Your system must be built to achieve these objectives. Step 3. Understand your market stocks, Forex, futures, crypto. Each has different volatility, behavior, and opportunity. Pick one and master it. Don't try to trade everything. Step 4. Identify your beliefs. This one's often skipped, but it's critical. Do you believe the market is efficient? Do you believe price reflects mass psychology? Do you believe news drives movement? Your beliefs shape the rules you create. Unexamined beliefs lead to contradictions, and contradictions kill consistency. Step 5. Define your setup. What conditions must be present for you to consider a trade? This includes price action, indicators, volume, time of day, or anything else. But be specific. Your setup should be so clear that anyone could spot it from your description. Step 6. Create entry rules. Once a setup is present, what triggers the trade? A candlestick pattern? A moving average crossover? A break of structure? The key is consistency. Same trigger, every time. Step 7. Determine stop-loss placement. This is your exit if the trade goes wrong. It protects your capital and your psychology. You can use percentage-based stops, volatility stops, structural stops, e.g. below swing low. Just make sure it's rule-based, not emotional. Step 8. Create exit strategies for profits. When do you take money off the table? Use fixed targets, trailing stops, partial exits. Your exit rules define your edge. Without them, you're just guessing when to close trades. Step 9. Design position sizing rules. This is where you control risk and reward. How much will you risk per trade? Do you scale in or out? Is your size based on volatility? Tharp says this is the most powerful lever in your system. Step 10. Plan your daily routine. When will you trade? How will you prepare? What markets will you monitor? Professionals don't just trade, they prepare and review like athletes. Step 11. Backtest your system. Before going live, test your system on historical data. This builds confidence and exposes flaws before real money is at risk. Step 12. Simulate in real-time use demo accounts or forward testing to live the system. You'll discover emotional triggers that backtests can't show. Step 13. Document every rule. Write it down, clearly and completely. A documented system is a trade plan. A system in your head is just a habit. Step 14. Review and refine. Regularly. No system is perfect forever. Review performance monthly or quarterly. Make data-driven tweaks, not impulsive changes. Lesson 5. Choose a concept you believe in. So you've decided to take trading seriously. You're building a system. You've got your journal open. You're testing strategies. You're thinking like a professional. But here's a question most people skip. Do you actually believe in what you're trading? Not whether it makes sense on paper. Not whether it looks profitable on backtests. Not whether someone on Twitter swears by it. But do you believe it works? Because if you don't the first time it fails, you'll abandon it. You'll second guess it. you'll jump to something else, and your trading journey becomes a loop of system hopping and emotional burnout. The foundation of any strategy is belief. Van Tharp is clear: your beliefs shape your behavior shapes your system shapes your results. So, what does it mean to believe in a concept? It means you trust it through drawdowns. You understand how it makes money. You accept its limitations. You feel emotionally comfortable trading it. If any of those pieces are missing, your system will crack under pressure. Common trading concepts and how to find yours. Tharp explains that there's no single right concept, just ideas that align or misalign with your psychology. Let's break down a few popular ones. 1. Trend following. The trend is your friend. This approach rides strong market momentum and cuts losses quickly. It often has low win rates, but huge winners. Perfect for patient traders who can endure long periods of flat performance, waiting for those home run trades. Bad fit if you need a high win rate to feel successful. 2. Mean reversion. What goes up must come down. This concept bets that markets eventually return to the average. Great for calm, statistically minded traders who believe in equilibrium. But if you hate being wrong 5 times before you're right once, this may not be for you. 3. Breakout trading. Big moves start fast. Jump in before the crowd. Good for action-oriented traders who love volatility and adrenaline. But if fast reversals or fakeouts trigger panic for you, this may backfire. 4. Fundamental trading. Price eventually reflects value. Great for traders who love deep research, macroeconomics, and company analysis. Bad for those who want immediate, technical, chart-based signals. 5. Market making, arbitrage, algorithmic models. Niche concepts that require special tools and precision. Fantastic for system builders, coders, or quants. Terrible for discretionary traders who thrive on human intuition. Warning: don't chase. What you don't understand. Let's say you see someone making millions with trend following. You try it. You get stopped out 9 times in a row, waiting for that one winner. But emotionally, you can't handle the losing streaks. So you quit. Then you find a scalper making quick profits. You switch again. Now you're overwhelmed with noise and too many trades. And before long, you're confused, discouraged, and broke. Not because you were stupid, but because you didn't build around your belief system. Ask these 5 questions before choosing a concept. 1. Do I understand how this concept makes money? 2. Can I stick with it during losing streaks? 3. Does it align with how I naturally think about markets? 4. Does it fit my lifestyle and time availability? 5. Can I emotionally handle the outcomes this strategy produces? If the answer is no to even one, redesign or rethink. Real-life example: the unbeliever's loop. Tharp once coached a trader who tried 8 different strategies in 1 year. Each time one had a losing week, he dropped it and searched for the next winning concept. What he didn't realize was each strategy worked, just not for him. He didn't believe in any of them deeply. He was addicted to chasing safety, not building conviction. It wasn't the strategies that failed. It was his inability to commit to one he could believe in. Belief isn't optional, it's structural. Without belief, every system becomes temporary, and trading becomes torture. You must believe in your system, your edge, your process, your ability to stay consistent through noise. That belief won't make you invincible, but it will make you unshakable. Lesson 6. Your strategy must match the market environment. Picture this. You're fishing with a net designed for rivers, but you're standing in the middle of the ocean. That's what it's like when you use the wrong trading strategy for the wrong market environment. You're applying the right tool in the wrong conditions. and then wondering why nothing works. Dr. Van Tharp makes one point very clear in this chapter. Your trading system does not exist in a vacuum. It must be built around the environment you're trading in, or it will fail. Markets have seasons. Just like nature, markets go through seasons. Trending, clear directional moves up or down. Ranging, prices chop sideways with no commitment. Volatile, large erratic swings in both directions. Calm, tight consolidation, low volume, low energy. Expanding, fresh breakouts, high momentum. Contracting, tightening ranges before a big move. Now ask yourself, does your system thrive in one of these environments? And just as importantly, can it survive in the others? Because a breakout system might crush it during high momentum, but get destroyed during choppy ranges. A mean reversion strategy might work beautifully in a calm market, but get annihilated when price starts trending hard. Understanding the big picture. Macro environment. Tharp also reminds us it's not just chart conditions, it's global conditions. These include interest rates, inflation, and monetary policy, government intervention, debt cycles and credit conditions, political uncertainty, war, pandemics, natural disasters, investor sentiment shifts, fear, greed cycles. These forces shape entire asset classes. Example, in a rising interest rate environment, growth stocks tend to underperform. During global fear, safe haven assets like the USD or gold often spike. When central banks pump liquidity, equities boom, even if fundamentals are weak. If your system is blind to the macro forces, it might still work technically. But you're sailing without a compass, and the tide is moving fast. Choose a system that fits the environment you're in. There are two ways to approach this. 1. Adaptive systems that change with the environment. These are more complex. They use market filters, volatility measures, or regime shifts to adjust strategy type. Example, a system that uses Bollinger Bandwidth or ATR to detect compression, then switches to breakout mode. 2. Specialist systems that work well in one environment and sit out during others. These are simpler, more focused. Example, a trend-following strategy that only trades after a confirmed breakout and avoids sideways markets completely. Tharp emphasizes both can work, but the key is knowing what your system is built for. Most traders ignore this and pay for it. Ever wonder why your perfect strategy suddenly stops working? It's not broken. The market changed. You didn't. And because your system wasn't designed to adapt or sit out, you kept trading, and you bled. That's why understanding environment is not optional. It's the difference between controlled risk and slow, consistent sabotage. Practical step, ask these questions before every trading session. 1. What is the broader market context today? 2. Are we trending or ranging? 3. Is volatility rising or falling? 4. Are any major macro events approaching? Interest rates, earnings, war? 5. Does my system make sense in this exact condition? If you can't answer those, or you're unsure, consider sitting out is a position. Sometimes no trade is the best trade. Real example, the 2008 lesson. During the 2008 financial crisis, many technical traders got wrecked. Why? Because their systems were built for calm, range-bound markets, not for panic, liquidity crunches, or massive institutional selling. The ones who survived, or even thrived, had either systems designed to trade panic, or the discipline to sit out entirely, the lesson. Your system must account for the reality of the market, not just your favorite pattern. Lesson 7. 6 traits of every great trading system. Let's cut through the noise, the indicators, the strategies, the patterns, the setups. None of it matters if your system isn't built on the right foundation, because a beautiful system on a weak frame still collapses. great trading system must have. These are not fancy tricks. They're not technical secrets. They are universal qualities that make the difference between consistent profits and slow disaster. If your current system doesn't include these 6 traits, it's not a matter of if you'll fail, it's just a matter of when. Trait 1. A positive expectancy. Expectancy is the core math of your system. It tells you how much money you can expect to make or lose over the long run. Van Tharp defines it like this: expectancy, average win, X win rate. Average loss, X loss rate. If your expectancy is negative, your system is mathematically doomed. A great system makes money over time, even if you lose frequently. Trait 2. Defined entry and exit rules. Great systems don't guess. They don't say, "I'll know when I see it." They have clear rules: when to enter, where to place your stop, when to exit for a loss, when to exit for a gain. These rules remove discretion. They eliminate emotional decision-making. Your system should trade the same way whether you're having a great day or a terrible one. Tharp emphasizes, clarity is confidence. Ambiguity creates fear and inconsistency. Trait 3. Risk control is built, and you can't talk about systems without talking about risk. Every great system includes defined risk per trade, e.g. 1R or 1% of capital. Stop-loss enforcement. Position sizing rules based on volatility or capital. Why? Because even a system with positive expectancy can destroy your account if you size trades recklessly. Van Tharp says, position sizing is the most important part of your system. It determines whether your system generates consistent equity growth or emotional chaos. Trait 4. Consistency of execution. A great system can be executed with discipline, regardless of mood or emotion. That means fewer discretionary decisions, fewer variables to second guess, fewer exceptions. If your system is too complex, emotional, or conditional, you won't follow it when it matters most, during stress. Tharp makes it clear: simple, boring, and repeatable will always outperform complex and clever. In fact, he shares stories of traders who made fortunes using systems based on a single rule, not because they were brilliant, but because they were repeatable. Trait 5. Fits the trader's beliefs and psychology. This is the game changer. A great system doesn't just look good on paper. It feels right to the trader using it. If you hate long hold times, don't build a swing system. If you get anxious watching charts, don't scalp. If you hate being wrong 60% of the time, don't trend follow. Tharp says, a great system is not about being right. It's about being right for you. This is where most traders fail. They build a system they admire, not one they can sustain. Trait 6. Adaptability to changing conditions. Markets evolve. Volatility rises. Correlations shift. Trends break. A great system adapts. That doesn't mean you overhaul it every week. It means you know what conditions your system thrives in. You know what conditions to avoid. You have rules for sitting out when the environment changes. Whether through filters, volatility triggers, or multiple systems for different conditions. Your system should never assume the market will stay the same. Because the moment it doesn't, rigid systems break. Adaptive systems bend and survive. The perfect system. Myth Van Tharp destroys a dangerous idea in this chapter. There is no perfect system. What exists are systems that have edge, are risk-controlled, are built around your personality, and can survive over time. If you keep chasing the Holy Grail, you'll never stay with one system long enough to let it work. But if you build one around these 6 traits, you'll give yourself the only real edge that matters: the power to execute with confidence, even when it gets hard.